Hey guys, Dave Keller here with Market Misbehavior. Put out a video last week talking about 3 mega cap growth stocks, Meta, Amazon, and Alphabet. I got some questions about how you actually play some of those patterns. So today I want to talk about the 3 steps to every pattern. Are you waiting for all 3 steps to be confirmed and actually be confident in pulling the trigger? Before we get to the charts with the 3 steps you need to pay attention to, here's one more thing I wanted to tell you about. Today's video is brought to you by Seeking Alpha's Alpha Picks. The Alpha Picks product is essentially an institutional quality alpha model or quantitative model. What you do is you look at the characteristics, the factors that describe a stock just before it really starts to do incredibly well, and you look for those historical winners and try to back into what you could have identified before they really started to grow. They look for those same powerful combinations of factors in the markets today. One of the stocks that they highlighted back in November of 2022 was a smaller company called Super Microcomputer. That name might be familiar because it's gone on to become one of the top performing names of the S&P 500 in the first half of 2024. They are now looking for the next Super Microcomputer, those next big compounders that will have periods of potentially explosive growth. If you go to marketmisbehavior.com/alphapicks, you can have access to an institutional level model like their Alpha Picks product. Now, it is in an affiliate link, which means it gives you a better deal than you would have normally, and also helps me to make Market Misbehavior awesome. So if you go to marketmisbehavior.com/alphapicks, you can find more information about the special deal that they're running around the 4th of July holiday. I hope you can check it out and help identify one of those next big winners. Now let's get back to the charts. All right, so today we're looking at Amazon, and again, we did a video at the end of last week. We have a link in the description where we talked about 3 leading mega cap names: Meta, Amazon, and Alphabet. And our assessment was these are 3 key charts to watch in July. Meta because it potentially is going to be breaking out. Alphabet because it's been in a protracted, extended uptrend, and the idea is, can it continue to make higher highs and higher lows? And then there's Amazon, which has just recently broken out. I thought it might be helpful to take the example of Amazon and dig a little bit deeper to talk about the 3 steps to every pattern. I find when people are just learning technical analysis, they tend to oversimplify a little bit and tend to get a little too eager to buy breakouts and sell breakdowns. And when they see a pattern maybe starting to form, they say, oh, that's a head and shoulders pattern or a triangle pattern or whatever it is. And then they just make a bet. And they forget that a pattern of any sort, whether it's a traditional price pattern like a head and shoulders or a triangle pattern, or just a simple breakout or breaking above resistance, I would argue that there are 3 steps to every pattern. This is a pattern of a game plan that I've developed over the years, doing a lot of technical analysis and looking at a lot of charts, and really drawing from some of my mentors that really focused on looking for confirmation. So here are the 3 steps to every pattern. We're going to use Amazon as the example here. And just to start, remember, Amazon over the last 12 months overall has been quite strong, spent most of the time above 2 upward sloping moving averages. That's pretty bullish. Although in April and May, and really the first half of June, had kind of stalled out. We reached $190 a share here at second week in April. We retested essentially that same level the second week in May, got right almost up to that level again in early June, but then finally over the last week or so, we have broken above that level. And this is the point we're going to talk about and identify the 3 steps. The first step is called the setup. And I would say that the setup is what a lot of people think of as the whole game, right? It's when your eyes tell you there's a pattern there. Now, you may call this a couple different things depending on how you would measure it. And I'll show you kind of what I mean here. What I'm looking at is this level of resistance right here. Okay, around $190 a share. And again, why do you draw resistance levels at a particular price point? It's because it's confirmed a number of times. The more times that the price touches that particular price level, what we call a pivot point, the more and more valid it is, because just the market is assigning a greater value. Investors are tending to gravitate around that price point. So here we first met it in April. We tested it a couple times here in May. We tested again in June. We finally broke out. So the setup is this period right here where it looks like some sort of pattern. Now, if you draw the lower boundary in here as well, so I'm connecting the low from late April and the low from late May, you could label this an ascending triangle pattern. And that is a traditional price pattern that can happen in a bull or a bear market, although, I'd say it's more, you could do it in either market, to be honest with you. What makes an ascending triangle an ascending triangle is the resistance level is fairly stable. So 190 is sort of the ceiling for this chart for about 10 weeks or so. And then the lows are getting higher. And so the ascending triangle pattern, you look for a break out of the pattern, usually resolves to the upside. It tells you that there's a new upside momentum that has been introduced. But even if you don't connect the lows and you just look at this resistance level, I would say either way, the setup phase, right, is where you see the pattern starting to form. You can tell it's resistance, you've started to identify these levels, and you're able to draw something on the chart. The second part is very important, and this is the trigger. And I find what a lot of new technical analysts do is they're way too eager, right? They see what looks like it might be a head and shoulders pattern or a triangle pattern, and they make a trade immediately thinking, all right, it's probably going to play out, so I want to make the bet now. What happens, though, is you will have false breakouts, and you will have things that don't ever actually move where you think they might. And so it really pays to wait for that trigger. So the trigger is the thing, the moment. That's the thing you're waiting for that tells you, yes, this is definitely a pattern. And if you read back the classic literature on technical analysis, I'm talking Edwards and McGee, written in the mid-20th century, they talked about the importance of a pattern is not a valid pattern until you actually confirm it by breaking out, right? By actually exiting the pattern. Then and only then can you label it as a pattern. So before that moment, you would have to call this a potential ascending triangle or an ascending triangle-like pattern, because it's starting to show some similarities, but we haven't really had that trigger, that second step. So the second key step, the trigger on this particular chart, is when we actually close above 190, because that shows we have exited this pattern, which is now more and more obviously clearly defined. The third step is where a lot of people don't wait for. They see the trigger and they make a trade. But what you have to remember is this concept of follow through. A lot of my mentors, and I'm thinking John Murphy, who wrote the first book I ever read on technical analysis, now serves as the chief technical analyst at StockCharts.com. Tom DeMark, Larry Williams, both of which I've spent a lot of time with at times in my career. They each, separately and differently, but also together, all have this idea of follow through, this concept that after you have a signal, you have to wait for some sort of follow through. John Murphy, it was more having a particular move in the chart that would confirm what had happened. For Tom DeMark, it was using particular highs and lows as a way of validating that something would happen, or trading one or two ticks higher after a particular signal. At the end of the day, I think it's just something that would tell you that whatever happened, that trigger phase wasn't a fluke. It wasn't a whipsaw, because a lot of times a chart will trade right up above resistance and even close above resistance, but the very next day we go right back below it and it wasn't confirmed. And that's the third step, is the confirmation. So in this case, after the breakout, which was about a week ago, we can see we've now had additional closes to the upside. So we've seen that additional buyers are coming in. After that breakout day, we weren't done. Additional buyers have come in and have bid the price higher, now all the way up to closing around $200 a share today. So those are the three steps to every pattern. And I would tell you, as you're looking at more and more charts, make sure you identify those three parts, because a lot of times people just start with the first step, which is the setup. And that is an underdeveloped pattern. You really shouldn't be making any definitive decisions with your capital based on just that setup phase. That's where it starts to look like the pattern. Make sure you wait for step two, the trigger, which tells you that the moment you're waiting for is actually there, and then the confirmation, an additional follow-through of sorts that tells you it wasn't a fluke, the momentum is actually going to continue in that direction. So those are the three steps to every pattern, using Amazon as an example. Where are you seeing patterns here in the market? Make sure you drop a comment below and give me a ticker and a pattern that you're finding. Maybe we can look at them together in our next video. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, have a good one.